Hello and welcome to our new video. This video explains the risks involved in selling options. We use the TastyTrade platform for our trading. If you wish to sign up for a TastyTrade account, please use the referral link in the description. Hope you enjoy. When we are buying options, the maximum amount we can lose is the amount we paid for that option, so we have a defined risk. The TastyTrade platform also provides us with the opportunity to sell options. Selling options is a great way to trade that put the odds in your favor, but the risk profile is very different to buying options and is often described as undefined risk or naked options. Let's take a look at what happens when we sell a naked call in Google. On the screen now is the options chain for Google company. We have selected the $175 strike price, but notice how the strike price is highlighted in red as opposed to green in the previous examples. This indicates that we are selling the option. To sell the option, we click on the bid price. When we sell an option, we receive the limit price as a credit. The area highlighted in yellow shows the limit price is $3.25. Remember, all equity options are based on 100 shares, so we multiply the limit price by 100 and our total credit would be $325. To work out our break-even, we add the limit price to the strike price. So if we add the $3.25 limit price to the strike price, we get a break-even of $178.25. If the stock price of Google is below our strike price of $175 at expiration, we keep all of the credit received and profit the full $325 credit. Another way to profit from this trade would be to buy back the call option at a lower price. As the expiration of the option gets closer and the option is still out of the money, the value of the option decreases. So we can repurchase the call and profit the difference between the credit received price and the repurchase price. Have a look at some recent trades in McDonald's company to explain further. On screen now are two trades. The one highlighted in green shows that we sold a 290 strike call for $231 and bought it back for $124. Which made a profit of $107. Similarly, the trade highlighted in yellow shows, we sold a call for $242 and bought it back for $132, which made a profit of $110. Now, if we go back to our earlier screenshot of the Google options chain and explain some other attributes. The area highlighted in green shows the buying power effect of selling the call, which is negative $2,061.76. TastyTrade temporarily remove this amount from your buying power as collateral and hold it until the trade is closed. You will get back all of the collateral plus or minus any profits or losses when the trade is closed. The area highlighted in blue shows the max loss, which is infinite as the stock can theoretically keep going up, and as the seller of the option, you will need to provide the difference between the strike price and the stock price. This is where large losses can occur. We explain this in more detail on the next screen. The area highlighted in white shows that the maximum profit you can make from the trade is $325, which is the credit you receive for selling the call. So the absolute maximum we can make on this trade is $325. Now let's have a look at a trade when things are not going to plan. When we are selling options, we can adjust our positions by rolling out in time and collecting more premium, or by rolling up the strike price to reduce the losses. We can see from the area highlighted in red that the last traded price of McDonald's company was $303.36. The area highlighted in yellow shows the history and adjustments made to our short call position. The opening position starts at the bottom row on the 12th of August, where we sold a 280 strike call for $265. On the next row up, we rolled out in time and kept the same strike and collected another $202. The next row up shows that we rolled out in time, but also adjusted the strike up to $285 and collected a credit of $1. Then on the top row, we rolled out in time again and kept the 285 strike and collected another $138. The area highlighted in white shows a summary of the position as it currently stands. We have collected $606 and have a current unrealized loss of $1,764. The area shown in blue is the current mid price of our 285 short call. which is $23.70. So if we want to close out this trade, we would have to pay $2,370. If we subtract our credits collected of $606 from the mid price of $2,370, we are left with our current unrealized loss of $1,764. The plan is not to close the trade and take the loss. We plan to keep rolling out in time and adjusting the strike price up to eventually make a profit on this trade. This example highlights both the pros and cons of selling options. The pros are the ability to adjust the trade and keep collecting credits and improving break-evens, but the downside to selling options is the potential losses due to large stock moves. We'll post another video in 2 to 3 months and provide you with an update in this position to see the effects of adjusting our short call. Thank you for watching this video. If you have any questions about the video or you have a topic you would like me to cover, please leave a message in the comments. See you then.